Good evening. My name is Mark Barnico, and I'm the Executive Director of the University of Chicago Yuan Campus in Hong Kong. Welcome to the China on the Move series. We're sharing tonight's event live via Zoom, Facebook, and YouTube from the UChicago Yuan Campus in Hong Kong. If audience members have questions to submit, you can do so through the questions and answer buttons by first registering on Zoom. I also encourage you to visit the UChicago Yuan Campus website at www.uchicago.hk and subscribe to our e-news for the latest programs and information. We'll wrap up tonight's program as usual with a poll and more information about upcoming events you may be interested in. So please be sure to stay tuned until the very end. Tonight we'll continue our previous topic on the series on China's real estate market. But let me first start this evening with a brief introduction of our moderator tonight. Kenneth Pomerantz, our faculty director of the University of Chicago campus in Hong Kong, will moderate this evening's webinar. Professor Pomerantz is a distinguished university professor of modern Chinese history and in the college. Professor Pomerantz's work focuses mostly on China, and he's also very interested in comparative and world history. Most of his research is in social, economic, and environmental history, but he's also worked on state formation, imperialism, religion, gender, and many other topics. Ken, thanks for joining us this evening. I'll hand the stage over to you so that you can introduce our panelists and get the program started.
Thanks very much, Mark, and thank you everybody for tuning in. I think this is going to be an exciting program. So I will get straight to the introduction of our speakers. Joseph Gyourko is the Martin Buxbaum Professor of Real Estate, Finance and Business and Public Policy at the Wharton School of the University of Pennsylvania. He also serves as the Nancy Nasher and David Hemesgar Director of the Zell-Lurie Real Estate Center at Wharton. Professor Gyourko's research interests include real estate finance and investments, urban economics and housing markets, both in the United States and China. He's a research associate at the National Bureau of Economics Research and served as co-director of the special NBER project on housing markets and the financial crisis. Professor Zhiguo also served as co-editor of the Journal of Economics, is a past trustee of the Urban Land Institute, and director of the Pension Real Estate Association, and consults to various private firms on real estate and policy matters. Then we have Zhiguo He. Zhiguo He is the Fuji Bank and Heller Professor of Finance at the Booth School of Business at the University of Chicago and the director of the Becker-Friedman Institute for Economics in China at the University of Chicago. He got his BA and MA from Tsinghua University in Beijing and his PhD from Northwestern, for which we forgive him. Professor He's research interest lies primarily in financial institutions, macroeconomics, and financial markets. He teaches an elective MBA course, The Chinese Economy and Financial Markets, and is conducting academic research on Chinese financial markets. He has also been writing academic articles on cryptocurrency, blockchains, and related matters. He's won a number of awards for his research and has published in the American Economic Review, Econometrica, Review of Economic Studies, Journal of Finance, and various other places. And he served as the guest editor of the Review of Finance for its special issue on China in 2020, 2021. Matt Lowenstein is a Hoover Fellow at the Hoover Institute at Stanford University, and he studies the economic history of modern China from the late imperial period to the early People's Republic. His dissertation, which he's currently turning into a book, is a study of northern China's indigenous financial system from the late Qing to the early Republic, and it won the Saller Prize as the best dissertation in the social sciences division in 2021. Other interests include the history of traditional Chinese accounting, political economy of warlordism, and the history of central economic planning. Lowenstein received his PhD in history from the University of Chicago after a BA at Cornell and an MBA from Columbia Business School. He worked as a securities analyst in Beijing and New York, covering the Chinese financial sector before he returned to academia, and his non-academic works have appeared in The Diplomat, Foreign Policy, and elsewhere. So it's a great panel. It should be a lot of fun. We will start with Zhiguo.
Thanks a lot for having me in this great panel, exciting topic. So I do prepare certain slides. Let me share the slides. The real estate problem in China obviously is many aspects. So I thought that I would just pick one important aspect that I think it's a fascinating difference between China and other parts, and also pinpoints to the policymakers' main concerning issues. So this is about the pre-sale, okay? And I hope most of the audience here immediately know what I'm talking about, but I'm just quickly just getting through the core. I prepared like 7-8 slides, so each slide will fly through. Some slides I will pay more attention to it. This is from Bloomberg, and obviously nowadays that these news it's not there. And when I travel back to China, various parts, I didn't hear those things anymore. But this is basically prompts all the policymakers. These mandates, and these are kind of like the supporting policies around that time. This is also gets to the point where it's not only the problem of real estate developers, right? It's about a human, it's about the people, and this is where the Beijing really put the emphasis on. So what is this? It's basically that you as a Chinese citizen, including me and my parents, when we buy houses, it's actually buying a forward contract, which means that in the near future, the developers gonna deliver these stuff to us. Now, when these real estate developers were functioning, nobody paid attention, and they would be happy. And a lot of people was really tried to secure a house even before its completion, because the housing prices are rising, all these things. So we were very happy to buy the house, and in the normal time we will get back in 5 years or 3 years. But then now it's getting to the trouble because these real estate developers stop working. So as a result, that in the same time, think about it, that when I buy the house, I already started a mortgage. So the bank already paid, and I'm paying bank afterwards. But the house is gone. So what do? Then I will feel like forget it. I will not just pay the mortgage. Now, when you stop paying the mortgage, you are hurting the banking system. And this is where the policymaker become uneasy. So those are the things that start from there. So as I said, that in China, it's a very prominent feature of pre-sale. So here's just some picture to give you a sense of the fraction of a pre-sale and fraction of established building. So for China, 70% of our new houses. So that's very important because China is, in the state of still, in the sense that the 30 or 40 years of growth, 25 years of a housing market. Modern day of a housing market where houses can be traded. So it's 70% of new houses still, 30% is previously owned houses. Among new, then 80% are purchased pre-sale. Sometimes when you read all the other documents, you will see it's called off-plan, but it's just the same thing, pre-sale. You pay before you get the stuff. So you can see here the blue line is a majority. Now, what's interesting about the U.S. is it's 12% of new houses. That just represents that the U.S. is already getting to the steady state, right? It's just a very, very mature economy. So 12% of new houses, 88% previous owned houses. So as a result, if it's a previous owned houses, obviously there's nothing about a pre-sale. However, it's interesting that among new houses, then it's also pre-sale. Okay, so within 12%, 70% of these new houses are also pre-sale. So which means that this is a fundamental issue. When you try to sell the new houses, it's a very common practice across the world to have a pre-sale. Okay. Now the devils are in the details of how you manage these things. Okay. So in China, this is the my assistant Wei Wei really helped me. She's in the audience. So this is the top is China, about it is the US. So some important factors. Think about it. Here's a developer signed a contract with a buyer, but a promise to deliver these condominiums, let's say, in 3 or 5 years, 2 to 3 years. Often the time that you need to finish up to 2/3 in order to qualify for the sale. It's not like you have the land and then you can sell or the future. You have to have a certain pre-qualified status so that you're almost done. Let's say 2/3, but it's not done yet, right? Then it take another 2 to 3 years to finish. Then the buyer typically will pay the down payments. In China, lots of very big portion is down payment. Depending on if it's a second home, then it's like in the past like 70 to 80 down payment, and then they pay the banks monthly payment. But if you look at the bank and the developer, the relationship is very clear. Is that the bank are going to pay the developer the full price because buyer already signed a mortgage contract there. So together with the mortgage part, the bank are supposed to pay developers. The question is when do you pay? The practice is that the same bank in charge of an escrow account, which is the money that is supposed to be paid to the developer, and the mortgage and together with the mortgage. So basically, there's one bank to managing everything. And unfortunately, this is kind of like everywhere in China. The process is extremely opaque. If you read the contract, then the banks are going to make a staged payments to the developer based on the project progress. In practice, become very murky. In Germany, it's extremely, it's kind of a similar thing, but the core is that in Germany and the UK, they use a slightly different setting, like the US. I'm going to basically they separated the escrow account with the mortgage service account. So let me go to the US. Now, in US, you probably most of the people know it's the same kind of thing, which is a developer to buyer condominium. If it's a single family homes, it's much shorter, but the condominium is longer. So in that sense, it's very similar to China between developer and a buyer. The difference is between there's one small difference between buyer and the bank. Here is the down payment is much smaller, okay, and then the buyer gonna usually starting pay after the property completion. Now the question here is that the escrow and the mortgage servicing account are totally separate, so that the so-called third party of escrow account will managing the process and hopefully which is true that at least nothing pops out as a very serious at this point, that they will monitor the process and then follow the rules. Okay, so these are the issues, and I do know a bunch of people in China on developer side as well as the bank side. Often the time it's basically that the main issue is really the housing market is too hot, so that they just wanted to get it fast, to get stuff out, and also buyers would like to secure that. They don't mind it as long as it's delivered. So what happens now is kind of getting to the test of this model, and it turns out to be extremely fragile. Okay, here's another figure that some people might know. This is a accounting issue of the Evergrande. So now we move to the developer side. So I picked the 3 developers. One is a Longfor, the other is a Country Garden, the third is an Evergrande. Evergrande is the first one that get all the attention. Country Garden recently got attention. So, and the fourth is Longfor. Longfor seems to be the flagship private, three of them are private, flagship real estate developers, Long 4. Long 4 seems fine, still fine. And now I expect it will be fine. But who knows, right? It's just the time horizon is very long. So what happened is what I plotted is the operating revenue over deferred revenue. And why it's deferred revenue? Here, the money that it goes to these pre-sale parts counted as a deferred revenue in the liability part of the balance sheet. So we could calculate or get a sense of how much is the pre-sale from looking at the deferred revenue. Okay. So what I do is operating revenue. So basically how many houses they're sold in terms of dollar cents, then divided by those pre-sale amounts. And you see here is this is the every year is about a flow, and then this is the balance. So the total that to be delivered. All of a sudden, usually about a 1. It's not saying that everything is a pre-sale, just to be sure, right? Because one is a flow, one is a balance. But usually it's about a 1. For Evergrande, there's a bunch of very weird, bounce around issue, and it turned out that there's some accounting issues, and just showing you that it's really the problem that the Evergrande gets into the problem is around the 2020. What happened was that during 18 to 20, there's some accounting standard changes, and Evergrande become extremely aggressive in recognizing the true revenue, not deferred revenue. So as a result, you will see that the deferred revenue dropped quite a bit, a lot. It's not like quite a bit. It's like really, really drop a lot, which makes that this index operating revenue divided by deferred revenue jump. And then in the 2021, they said that, look, the issue is that we really cannot complete these houses to be delivered. So as a result, we recognize the previous recognition, previous revenue recognition is too aggressive. So we change back to the previous accounting standard. Then this deferred revenue really jumped up quite a bit, and it spurs all the market concern and all these things. So this is basically that happened. Now I have 2 more slides. So the Beijing's reaction was that try to say that, look, real estate developers, we know this is an issue, this is a problem. To be honest, that we could just let you go. This is your own fault. They tightened, Beijing tightened it up. Some of the developers really followed the rules, some of them not. For instance, the Evergrande, I said it many times in the previous talks. But what's more important is to making sure that our people get their house. Okay, so this is a so-called 3 arrows program. What is the 3 arrows? One is banks need to step up to provide loans to making sure that these properties gets delivered. The second is bond issuance. The third is equity financing. Now, you might see that the recent change is that Beijing become extremely tough, but there's some boundary that Beijing can be tough in the sense that Beijing still need many parts to help to implement it, whatever their policy is. And over time, especially now, it's become harder and harder for the private, when I say private, including SOEs or like a market entity, to follow its rhetoric. And you will see here is a year-on-year growth. The banks still do not get to the housing parts, and then bond market also it's not very much. So this is just getting to the core issue of the recent problem that I will summarize in the last points. But this is the 2 slides very quickly, just telling you that seems to be making important progress. So I'm not very much worried about a pre-sale, but this is the trigger of all these things, and it's also squeezing the real estate developers a lot, because at this point it's a zero-sum game. So if you want to making sure that you deliver all the good things to the the people, which is supposed to be, okay, they promised, there must be that hurting someone, which is a real estate developer. So in 2305, that's May, the completion delivery rate is rising quite a bit, and the stage before delivery, this is like that. So you see that more than half of it, about half, is in the declaration. Here's what gets measured, gets managed. So why what I say, area completed really grows a lot. This is the percentage growth, and the area started, area under construction gets shrinked. So this is where that you see that these things no longer. So the blue line and the red line no longer counted as a GDP, right? Because blue line and the red line are the ones that are counted as GDP. You see that this part's economic growth will shrink, area completed going up, but that's already counted as a GDP long time ago. So this is where the lagging game that we're playing. So this is another important and interesting parts. So what I plotted here is a default on the domestic versus foreign of the bonds. So we have a project to try to trace through the potential the defaulted bonds in the incidents in the domestic and the foreign. What's interesting is telling you that in the earlier times, in 2018, 19, most of the default, right, you can see here, is in the domestic part. Foreign is very small. So in some sense, there's some priority they put it into the making sure foreigners are happy, but they do not default on the foreigners. In 2020, it's still the same. But in 2021, all of a sudden you get a shift that you see that the foreign default picks up. And in 2022, it's just a complete reverse. Another thing that is what's driving it is really real estate. Okay, so this really gets into the same story, which is that real estate being mandated, which is a good thing. Okay, this is a social responsibility they have to face. Is that they made a promise before. In the old time, they can play the game, keep doing. And then now that they're getting into trouble, but they have to deliver these pre-sale houses, and this is why they in some sense that they keep the domestic, but they give up on the foreign. Okay, final thing. I think a lot of people would like to know my perspective on these big issues. This time, give time to China. It's also that you realize that everything is changed. So the bottom line, we're in the correction phase. The correction phase seems to be that there's a lot of factors coming in. So the COVID, right after COVID, so we are now almost a half year. It's impossible to think that after 1 year just everything's gone, because you're thinking about old China or previous 10 years of China where the policymakers do not made up their mind. Policymakers already made up mind. They are adjusting themselves, but the overall big direction they made up their mind. So it's really the correction phase to transit China's economy from the old growth model to something new. Now, the something new is, you would say that the foreigners will see it's extremely risky. As an economist, I would also say I do not know where to go. But at least that there's a goal getting there. Basically, that housing market will be not that as high, and then all other parts of service consumption pick up. Now, the anything that Beijing can improve, that's a question mark. Okay, question mark. To my mind, that at this point it's still early to judge. Not much, except that they can pick a better timing in the sense that usually we have two engines for the economic growth. One is the exports played a huge role in the past. That was not the firing, right? We know this is a decoupling shock. And in the same time, it's the housing. So the timing probably not that good, but otherwise it's just, this is what you do. It is a cancer of the China's economy. It's an issue you need to deal with. And I can tell you, when I go back to China, I visit a bunch of places, including the top tier, middle tier, my hometown. it's zero impact on most of the low middle class people in China. They're making sure that the housing is delivered, all these things. This is what they care. Consumption, tourism are picking up quite quickly. Travel, all these things. Obviously, super rich class really got hurt this time. You see all these news about it. It's mainly from their perspective, right? You think about it, it's like stock market is not that good. VC not good, PE not good, foreign direct investment not good. Think about who's behind these activities. Okay. Last summary the points. The current price to rent ratio in China is still abnormally and crazily high. It's a 60-to-1. You take 60, it's a 60 years of a rent to pay the house. While in US it's about a 17.1. It's about think about it, it's about a 4. Therefore, this is in a country where everything's supposed to be much cheaper than US, but you have this opposite thing. So therefore, I'm strongly against the big scale buyout program on real estate sector. This is in the correction phase. We are not there yet. The important caveat, which is I, as an economist, really, really don't like what Beijing is doing, is managing the price. So caveat is that many cities do not allow developers to lower the price. Okay, so as a result, that the price to ratio number that I quoted here, 60.1, perhaps is correct in Beijing, Shanghai, where the price indeed do not change that much because demand is always there, but very likely is overestimated in other parts. Thank you. I'm
done. Thank you, Professor He. We'll switch now to Matt Lowenstein.
Thank you, Ken. Thank you, Mark. Really good to be here. And that was a great presentation by Professor He. I'm going to pick up where he left off and talk a little bit about how this cancer of the Chinese economy is spreading other parts of the economy in the financial sector and fiscal incomes in particular. So, as Professor He adumbrated, the pain in the property sector, the way we got to where we are today, is not just a policy choice by Beijing. It's part of some deep and longstanding structural problems, and that is that Chinese growth has been reliant on a lot of investment and increasing amounts of investment for many decades now. And you can see this in the swelling of the financial sector. And so what this graph is a little hard to read, but what it's telling us is that over the last 20 years or so, the Chinese banking sector has grown by about 350 trillion renminbi in assets. And in the last 10 years alone, it's added the equivalent. The new banking assets are the equivalent of 150% of the entire US banking system. So assets that took America over 100 years to accumulate have been created in China in the span of a decade. And there's nothing necessarily bad about that, as long as the investment is going into productive places, and that's really good. And that's how you get rocket-fueled growth. So we might say, instead of a cancer, the real estate in China is kind of like morphine. It feels not morphine. I don't know my drugs very well. Whatever stimulant feels really good at first, but is really hard to get off. Let's say caffeine. And the problem is that we do see evidence in the data that investment is not as productive as it used to be. And is getting increasingly unproductive over time. So one measure that analysts like to look at is something called the credit intensity of growth. And that just means for every renminbi in loans, how many renminbi in loans does it cost to get me 1 renminbi in GDP growth? And it used to be that actually you got to run renminbi from GDP growth for less than 1 renminbi in loans. Now you need a lot of lending to just get a little bit of GDP growth. So that tells us that that investment is just not as productive as it used to be. So why? Where is this investment going? Why is it less productive? Well, you probably guess the first answer is it's going into real estate, basically, and that's been true for some decades, for nearly 2 decades at least. This real estate is bought by people as an investment product, but it's not really producing real economy returns. And this is a picture of the halo of the Shenfu Xinxu. That's the new district between Shenyang and Fushun in Dongbei province. And it's got this incredible, kind of surreal emblem. I was there. I didn't take this picture, but I was there in about 2014. And it's just a forest of buildings, not a lot of people there. Very typical site in China. So you find these ghost cities, or cities with high levels of vacancy, often in places called new districts or new cities. And they're speckling the Chinese landscape, not really doing anything to grow the productive capacities of the country, but they're sitting on a bank balance sheet somewhere as if they were real productive assets. And the other place this shows up, the other outlet for investment is infrastructure. Now, infrastructure is great, and we all need infrastructure, but how much is too much? Chinese governments build a lot of railroads, a lot of factories, a lot of airports, and we're seeing signs here that there's over-investment in infrastructure. This is a photograph from Bloomberg of a stalled highway in Guizhou, and for the longest time, we've seen when a property project goes bad, we see something called lanweilou, abandoned buildings, all over China, and now we're beginning to see abandoned infrastructure projects. This stalled highway is near the city of Zunyi, which has 3 airports, one of which has only 4 flights per week. So that tells you that maybe there's been a little bit of overinvestment. And infrastructure and property are actually quite related. That is because the way that local governments finance themselves is, to a large extent, through property. This is because since 1995, local governments have not had control of their own tax income, but they are able to raise income apart from regular taxes by using the land that they own, their land bank, and they use their land as a kind of currency. So they can sell it, they can collateralize it for loans, and this augments the local government's budgets. And now land sales make up an estimated 25% of local government fiscal income. And of course, when you think about how this is going to be unevenly distributed throughout the country, some localities are even more dependent on it. And this helps explain a phenomenon that Professor He mentioned, and which I've seen as well in my travels in China, that local governments will not let developers lower the price. There's a saying, 有价无市, there's a price but no market. And this is because if the price goes down, that means the value of their land bank goes down. That means it's harder for them to raise to raise fiscal income, and perhaps even more importantly, it's harder for them to exert pressure on local banks to lend on their land bank. As long as the nominal price of the land stays high, they can often exert pressure on banks to lend on that. So how big of a problem is this? Well, it's hard to tell exactly, but there are many Chinese banks that are publicly listed companies on the Shanghai and Hong Kong stock exchanges. And so we can get a sense of how much how reliant these banks are on local governments from their publicly available disclosures. And it's estimated that about 61% of listed bank assets are some form of debt from local governments. This is quite likely an understatement because listed banks tend to be larger banks, and the further down, the more local a bank is, the more geared it is to local government lending. So even though this will not appear on a balance sheet as a property loan, these are loans that local governments rely on land sales to repay. And there's already rumors that this is causing pain, rumors of local governments halting funding of projects, cutting public services, and delaying payment of salaries to civil servants. In Henan province in particular, there's been a lot of chatter online about government officials not getting paid. To make matters worse, some of the land revenue wasn't even real to begin with. The National Audit Office found fraudulent sales of land in 70 cities around the country. Usually this works by moving land from one pocket into another. So you inject your land into a non-government entity and sell it to a property developer controlled by the local government, and you call it fiscal revenue. It also means debt is underreported, because another way you inflate land sales is you go to a property developer and say, hey, if you buy 100 renminbi of land from me now, after I report fiscal income, I promise to buy it back for 110 renminbi. And these repurchase agreements are very common in the property sector. Evergrande did the same thing to pretty up their balance sheet. I think I'm just about at time, so I'll just end with what's the government going to do? As Professor He said, they're very much aware of the problem. They want to crack down on real estate, but it's hard to do that because their local governments are dependent on it, and I think we're seeing increasing signs that they're unwilling to stimulate household consumption too much, and want to find what they really want to do is go back to a world in which returns on investment were as high as they were 10 years ago. And I think that's going to be extremely difficult. So with that, I'll yield the floor.
Thanks very much, Matt. And I will just turn it directly over to Joe.
Okay, thank you. It's a pleasure to be here, everybody. Thanks for having me. I'm going to play off both Matt and Zhiguo. And my work is really about markets in China, housing markets in particular. So I'm going to be fairly high level. And I'm going to talk about what I think the risks are from what strikes me as an inevitable price decline in Chinese housing. I take it as a given that will happen probably later rather than sooner, for all types of reasons, some of which have been discussed already, which is their bars on quick price drops. I mean, the government just says no in one way or another. So if you take that as a premise, I then ask, so what are the risks from such a decline? And I'm going to talk about four actors. The private developers that Zhiguo talked about. My view there is they're just not big enough to be systemically risky. They can be handled by the government. I think they will be in some way. What I think the most important effect of their decline is going to be in terms of economic adjustment. And here's where some of the data from Zhiguo, I think, is really telling and really important to understand, particularly if you're from my part of the world. The construction sector is enormous in China. So Ken Rogoff and Yang in an NBER piece and Goldman Sachs, Asia Research Group have both estimated the share of GDP made up by construction. It's a very large number, like 25%, and that includes downstream and upstream suppliers. And part of that number is 3 times the U.S. number. How can that be? It's what Zhiguo told you about. The 70% of the homes are new. We've had this massive rural to urban migration in China. You needed a lot of housing in a way you didn't in the United States, where urbanization's already happened, and the like. So that's a very big deal economically, because that sector has to shrink, and almost certainly by a lot, Once you get past this pre-sale problem that Zhiguo talked about, you're going to have, what the country has to deal with is the fact that while there's still rural to urban migration, it's going to be much slower because China is urbanized to a large extent, not fully. And there are a bunch of consultant and research reports out there. The pessimists think the flow supply of migrants into urban areas will fall by as much as 50% compared to 2010 levels. The optimists think it's a 20 to 25% decline. In other words, it's a big demographic change. Okay. And that's a tough thing. And if you do the math on this, it's a 5+ point change in GDP just from shrinking the construction sector. So it's that, to me, is the biggest issue regarding the private developers. It's not, did Evergrande misbehave and will Country Garden make it? It'll be, how does the country deal with what's going to be a serious decline in a sector that's going to amount to many GDP points. That's a tough thing. And it's really the up and downstream suppliers. You can lay off construction workers, but you've got all these steel workers and glass workers and people making products that go into the buildings in different parts of the country, and they're going to get hit too, in general. So I think that's the biggest long-term problem that comes out of the development sector. The other one, I'm going to get to the household sector now. This issue with the developers is very visible, right, to consumers. They see what's going on with Evergrande, Country Garden, and the like, and that means it can affect fundamentals and sentiment in general. So small changes in perceptions about growth. Zhiguo also mentioned the extraordinarily high price to rent multiples in Chinese cities, and that's not just Beijing and Shanghai and Shenzhen. It's many regular cities, that not as high as 60, but the median city, and some data that co-authors at Tsinghua and I worked on just before COVID in 2020 showed the median, price to rent ratio in about 100 across 140 Chinese cities was 35. That is, in real estate investment lingo, that's a 2.86 cap rate. 1 divided by 35 is 0.0286. You're trading at a 35 multiple. Small changes in expected growth can have very, very big changes in that multiple. Okay. In other words, one of the risks for the household sector is, as Zhiguo's data showed, housing is priced like a growth stock. And growth stocks can and often are highly, highly volatile. We have not seen the price volatility yet, but I bet we do at some point. So let me talk about the household sector. That's actor number 2. Here, the household sector is not, again, as Zhiguo showed, is not highly levered to housing. They have way more equity than the typical American homeowner does in their house. It's just a requirement in China, but it's a big part of their wealth. There's a 2019 PBOC study that I like to cite. I teach a housing markets class at Wharton, and 60% of household wealth was in housing. That number in the US is 26%. So anything that shocks values in this sector affects household wealth in a major way. We don't know how that will play out, but it's hard for me to believe we will not see wealth effects from housing. And I predict, Zhiguo and Matt and others will be studying wealth effects of house price declines in the relatively near future. And I think one of the things that is causing a bit of the malaise is exactly this. Imagine that, when you think about the user costs of housing, of being an owner, things that raise the user cost are your mortgage interest payment, your property tax payment in the US that doesn't exist basically in China, maintenance and depreciation, maybe a risk premium, and something that lowers the user cost is expected appreciation in the property. One of the risks that China faces and policymakers face is that it's possible that the decline in expected price appreciation is really high. And it could be higher among typical households than any interest rate reduction the government could come up with. And if so, that's going to change that price to rent multiple in a fairly big way. I think you could see really large double-digit changes in that ratio. Another risk in the household sector that we don't know much about, it involves speculative vacancy. And these are Zhiguo's richer households who own multiple units. They may rent them out. Many of them have never been rented out. There's some really interesting work by a research team at the Hanglung Center, Real Estate Center at Tsinghua, where they trained an algorithm to look at the pictures of units being, offered for sale, and they trained the algorithm to figure out whether the unit had ever been lived in. It was more than 10% had never been lived in. There are no marks on the walls, no nothing. This is subject to measurement error for sure. But think about if there's some coordinating event that leads these people to want to sell at the same time. These are big enough numbers to affect market prices. It's that type of thing that I think is risky from a household sector. It is not the American style risk that these folks are heavily levered to housing and they're going to default and walk away. The other reason they're unlikely to just walk away from mortgages is these are full recourse contracts in China, unlike the United States, and many of the lenders are powerful state-owned enterprises. Okay, so that's the household sector. Number 3 is local government. I'll be very brief here because Matt covered it, I thought, extremely well. That sector is highly levered to the housing sector in exactly the way he said. In the old days, local government financing vehicles, or they use their land banks basically as collateral to raise money to fund infrastructure and the like. An American mayor would commune with a Chinese mayor because they have unfunded mandates. They're not allowed to have various taxes, but they're expected to contribute to infrastructure development. And what do? They lever the biggest asset they own, which is the urban land. And the like. That's serious. The numbers are really, really large. I would expect to see some type of bailouts there because the numbers are so big, it will spill into the banking sector and the like. The fourth actor is one we haven't really talked about, and unfortunately, I don't know anything about, but that's the shadow banking sector. We just don't know how levered the trust products are to the housing sector. We see news reports about 1 or 2 trust companies these days. I'm sure the government's looking at it. I mean, the reason to pay attention is that's the sector that almost killed the U.S. financing system, and we don't know. So Lehman is famous in my country. Those folks bought 2, not 1, 2 subprime lenders before the GFC, and they filed for bankruptcy on September 15th, 2008. And on May 27, 2007, they helped purchase and provide the financing for a $22 billion apartment company. So these guys were running full steam on housing right almost up to the day they failed. That would be the risk in China. I'm told by my friends and co-authors in Beijing that the government's aware of it, but that's just a sector we should all watch. Because it's opaque, right? It's opaque around the world. They don't call them shadow banks for nothing. So in general, I think the potential for some type of systemic risk is real because of what's the nature of local government financing and the shadow bank sector. The government, I think, should be able to control and address this, but it will be expensive. So that means I don't anticipate a Lehman moment in China. But again, I didn't anticipate a Lehman moment in the United States, and it certainly did happen, didn't it? I think the longer run risks are unavoidable, and they're going to constrain growth. Construction's a very big sector, and it needs to shrink. The flow, China just does not need to build as many homes as it's been building because the short-term demographics from rural to urban migration are weakening, and there's no long-term ride to the rescue, right? The overall population is starting to decline after a few years of the working age population declining. So demographics won't ride to the rescue. and you'll just have to manage what could be interesting and potentially large wealth effects from the household sector. So I see it as more of a long run slog, that hopefully, there's not some short run financial problem, which I don't think there'll be, but could be. And with that, Ken, I'll turn it back to you.
Okay, thanks very much, Joe, and thanks to all our panelists. We've had an unprecedented number of audience questions submitted for this program, so I'm going to try and aggregate groups of them into single questions. And I guess for the first one, I want to start with this local government problem that all our speakers in one way or another have pointed to. I mean, China's not a federal system, right? You can't let a local government go bankrupt because, legally speaking, it's just an arm of the national government. So what would a bailout look like? And what price is Beijing likely to extract from the localities that it's going to have to rescue? Anybody have any guesses?
I have a guess, Ken, only on the first part. I
Okay.
do not. I'm an economist who works with co-authors at Tsinghua, and I just don't know enough about the politics to comment on number two. What would the quid pro quo be? But the bailout could come in many forms. I think I've heard rumors that there have been quasi bailouts because the government has told some institution, some state-owned entity, to essentially make a bid so that a government could refi its rolling over land loans. It could be as simple as that. It could be something really formal, and the like. But I think they'll do that as quietly as they can, because they really do not want that to snowball, right? They're correlated risks. If city A fails, everyone and their mother will be looking for cities B, C, and D who are likely to be correlated with A. Yeah. That's what the professionals at the PBOC are going to be thinking about. As to what the quid pro quo is, you need to talk to people who know the culture much better than I do.
Anybody else want to chime in on that one?
Very quick comment. In 2014, we did it. So it's called a debt swap program. Then it's basically all, by the way, clarify, whenever we say local government in China context is at the city level. The province is kind of direct arm of Beijing. So what the debt swap program at that time did was that all these bonds or debt were issued by the cities were swapped into the bonds that are liable at the province level. So that's kind of already from the local to central. Whether this is a good move, a lot of issues remaining, as you see that's really not solved the whole thing. So I will stop there.
Can I ask a question? I'm fast. So why do you think they haven't set up these bad banks? Why don't we have Cinda for local governments and the like? Is it just that it's too big? By the way, the debt numbers now are way bigger than in 2014. So it would take more capacity, but China's richer. It's a bigger economy.
One quick comment. I think a lot of people here like to hear, and I really think that's what's going on with the time, is the top. I mean, really the top. Okay, there's one guy top. Don't feel like the issue is a moral hazard. The issue of a moral hazard played a big role for a long time. So it's important to, I would say, teach a lesson or make the discipline on that problem. So which delaying and doing it in a very slow. This is points to the Ken's point. Probably it's like this is like a price you pay or price you extract from the local. Is to say that look, these things that you need to be responsible on yourself, and as a result, exposed that we are. I mean, the economy is paying some price, both sides.
Yeah, I'll elaborate. I think those are echo all those points and elaborate on it a little. I think that the anti-corruption campaigns are also kind of a way of disciplining the local governments and the entire bureaucracy. But I think there's a limit to what Beijing can extract, because if we want to see a sustainable pattern of governance, the local governments just need more tax revenue. So ultimately, I think the center will have to make some concessions as well, because it's not really like the local governments are just staffed by bad people. They're following the incentives that the system gives them, and these, by the way, their local governance burdens are just going to grow, because we're reforming the hukou system. Basically, it's the last vestiges of it are disappearing now. And so there's a lot of public services that local governments are responsible for. And so you can't just tell them, stop fueling this property bubble, stop interfering in property markets, stop selling land, because they have to get money from somewhere.
Yeah, let me use that as a segue to a kind of second order of questions. So, as Professor Gyourko laid out, a big part of the problem is going to be not just construction workers, but people who make glass, who make steel, et cetera, are just not needed in the numbers that they currently exist in. And this ties into something that lots of people inside and outside of China have been saying for 30 years, which is this country needs to make a transition to a more service-oriented economy. And we keep waiting for this magic bullet, and it keeps not arriving. How is this going to play out? And is there any set of policies that could make it happen less painfully, right? Because you're not going to turn all those redundant steel workers into nurses, certainly not quickly. So what has to happen here? And is there anything constructive that Beijing could do?
I could start. As you said, everybody is believing, most of economists, except several of extremely left-wing economists. One of them was actually a Chicago graduate. You probably know who I'm talking about. Still, fundamentally believe that investment is the driver. So there's a tension between investment and consumption. But from people like me, I feel like GDP itself is a very distorted measure for welfare. So as a result, that we should think about it more than the GDP. I think that lots of times that it's the I blame some of, I would say it's foreign, but like international commentators or these people. It's like now you see that China is trying to correcting. Then everybody is just saying no, you're a failure. Before that, they will say no, this is not good, this is not good. I mean, China is from what Beijing's policies pushing right now is saying that in real estate is the thing that these houses are for living, not for buying, frying. It's called a 炒房. So and the big transition, as Ken was talking about, is not an easy thing. So for instance, that one important, it's all connected, is on saving rates, and the saving rates, I believe it's connected to the safety net that a lot of people are mentioning. So that part seems still a long time reform has not to get to that portion yet. If there's anything that we should think it really through, before talking, I think that most of the consumption, like a tourism thing, the consumption habit has changed quite a bit. So for instance, my parents will never think about going outside to have a tourism. Never. They view that saving $1, that's the saving, every time saving $1, that's a real utility coming from it is. So I have, my parents, my mom, until her passed away, she refused to hire any nanny because she thought that, by hiring any nanny, she will like spending more money, which is really discomforting in her mind. So that kind of a concept already changed. This is a very good part of it. The question that you get to the Western style, where is you want to consume, but you have a budget constraint. You have to think about, later on I might get into the trouble, blah, blah. This is a good start. This means that they already have a desire to consume, thinking that this is the life supposed to be. At this point, that the government can do a lot to address the issue of a safety net in order for the people to feel like, this is maybe that, after the careful planning, they were able to consume. So on this part, that there's a slow reform going on, and I do think this is the matters for the future of 5 to 10 years.
Yeah, I think that's I'll just add very briefly. I think that's absolutely right, and the changes in household behavior are really cause for optimism. I would just say that structurally, I think the problem, the difficulties of rebalancing are less at this point, getting people to behave in a different way, and having less of the economy go to the government and corporate sector. So even if most of China's high savings rate is not actually from the high savings rate of households, it's from the amount of essentially retained earnings and fiscal spending, and basically the amount of resources being controlled by government entities, including state-owned enterprises, and also by very large private corporations. So rebalancing toward the household sector, I think is a problem that is easier said than done, both because of what Ken was saying. You have a state-owned steel mill. Okay, people aren't buying a lot of steel from it anymore, but those workers, you can't just snap your fingers and tell them to go start writing code for Alibaba. And at the same time, these are very, very powerful vested interests. And so what I see at present is a leadership that is paying a lot of lip service to rebalancing, but is still really hoping that they can invest their way out of it, and somehow raise returns on investment. And so you see a lot of talk about high quality growth, which means that we're going to invest in the high tech sector. And I think unfortunately, I think that is wishful thinking, and they would be better off just giving more resources to households and letting them take more vacations.
Just adding one point. Today, there's an announcement of cutting the personal taxes. So in some sense, there's the governing body at Beijing on this economic. There's a lot of people fighting. So I agree with you. Hopefully, they're getting something going.
Yes.
I can't resist just being a historian by profession. A lot of what we're talking about today reminds me of 30 years ago, reminds me of the 1990s. And on the one hand, of the tax reform that a couple of you alluded to, which at the time, many people said, Beijing couldn't pull it off, right? At that point, the problem was the tax revenue was way too bottom heavy. The localities controlled it all. Beijing didn't have enough. People were saying, they're just not going to be able to get the money out of the hands of the localities. They did it remarkably effectively. we are paying a price 30 years down the line because the way that localities coped has created its own problems, but they did it. Similarly, at about the same time, they restructured big part of the state sector, right? It was quite painful, especially in places like the Northeast. But in some ways, structurally, it was the same challenge they face today, right? They were making too much steel and too much cement and so on and so forth. So are there either positive or negative lessons for today if we think about that moment when some of us were still young?
I indeed was young, but I was in the college, like third, I went to college in 1995. I still remember Premier Zhiguo made his impressive speech on the TV, starting the SOE reform. The fiscal reform you talk about is around my time I went to college, where we getting to know what to do, but I feel like that memory is a little bit vague. But the SOE reform was extremely vivid still in my mind, because some of my classmates, their parents lost their job, and we kind of like have some donation going on. But your question is such a deep question, which is I often tell my colleagues here. I think that there's some positive and a negative side. So I have to say that the time of when I left the country in 2001, I would never thought that China can grow that fast in the past 20 years. That was right after the event that Ken was talking about, the SOE reform, a lot of stuff to be fixed, and Zhu Rongji would like to do these listing stuff, like SOE listing. That was the end of 2000. And I never thought that this could be successful. However, there's a big shock, which has really helped China, WTO. That was right after I left the country, and I was in a basement in Boston and hear that news. Of course, I didn't know that this is how much this will be, but it turned out that, all these will revolve back. You see that this is all these things, I don't know, it's coincident or not. Why I want to mention this, I want to say indeed that it, will be tougher this time. So let me stop there.
Ken, just one comment. It's a long run problem, right? Other countries have gone through it. I am probably the old guy on this webinar, and this is a version of this happened in the United States. I grew up in the Rust Belt in a small town in southwestern Ohio, and they're big structural changes, and I think it's a fairly big structural change China's going to go through. There were real pain points through it. If you grew up in the Midwest, you knew a lot of people who lost jobs for a very long time. And it has repercussions for our politics today. These countries go through this, China will too.
I think it's probably about time to ask all the participants if they have any last comments they'd like to make.
Yes.
It's getting late in Hong Kong, even though some of us are just getting our morning started. So maybe let's do a quick lightning round. Anybody want to offer some last thoughts?
Just think long run. Given what's going on and the potential for spillover into the financial sector, you do have to worry about that type of systemic problem. It's a long run issue. And I think one of the things that'll make it harder that Zhiguo raised is this basically much slower rural to urban migration. That really helped the Zhu government and the like, is they had this push that made the country fundamentally more productive. It's just harder to transition to a service economy than it is to bring, subsistence rural farmers into factory jobs. So it'll just be harder, but think long run. And like I said, be a historian. Not only has China faced problems before, so has the rest of the world.
Given that everybody is kind of like negative, I see two positive things in the recent trip back. One is this EV thing, EV car, very impressive, very impressive. It's in Shenzhen, bunch of car companies. The second one, as I said, is that now the current generation of Chinese citizens, they are open to consumption already. They already used to consume. Those things is a very habit driven, and also it's like a historical, they're memory driven. There's a significant amount of economic analysis showing that. So for that, that's basically the basic engine for economic growth. With the proper policy making, less much. I as economist of Chicago, obviously, don't like too much of a policy, but in China, you do need a policy as an initial starting point, initiation. Carefully designing those things that you do have a shining points are spotted around. It's not like everything's dark.
I'll end on a dark note. I think one thing that we didn't mention, and it's a challenge that's so big that when you bring it up, it tends to overshadow everything else. The demographics is just another. I'd say even bigger than the end of the rural-urban migration. The dependency ratio going from something like 1-to-1 to something like 3-to-1 is, as other countries in East Asia are, but at a much lower level of per capita income than South Korea or Taiwan or Japan. I think that will be probably when historians look back. They will talk about that as the severest long-term challenge, probably even more so than property.
I think it's worth noting, just to kind of humble us all, we all saw that demographic shift coming. Virtually none of us saw how fast it was going to happen.
Yeah.
Right? I mean, most models just a few years ago were showing, urbanization will slack off somewhere between 2030 and 2035. It's come a decade earlier. Most models showed that really serious change in the dependency ratio would be starting about now. Instead, it started a decade ago. We got the big picture right. We got some key details wrong, and boy, are those details important. And with that, I think I want to thank all our panelists, thank the audience, and turn things back over to Mark.
Thanks, Ken. And thanks to our guests tonight, the panelists. That was a really interesting conversation. And I hope we can continue to have this kind of conversation in the coming months as things change, with a little bit of optimism there and maybe some dark clouds ahead. So thanks so much for joining us tonight. We have a brief poll on the program tonight for the audience on Zoom. And if you're watching live on Facebook or YouTube, you can leave your answers in the comments below. And I just want to remind everybody, we do have programs coming up in September. We're not ready to announce those yet, but I'm sure you'll find them quite interesting. So I'll remind you, don't forget to learn more about our UChicago faculty and how they became professors by listening to the course podcast. You can find that on Apple, Spotify, Himalaya, and wherever you listen to your podcast. Again, thanks everyone for joining us tonight. We have a typhoon headed our way here in Hong Kong. So those of you in Hong Kong, please take care, be safe. We look forward to seeing you again soon. Have a great night.